Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How you doing today? See, it says it down there, over there, just so you know. Hey, this is our FinTips series we do real quick to talk about just something new, teach you something new, get out of the way. And today we're going to actually highlight some of the things that we talked about on the Closing Beat, which is our daily show at 5 o'clock that we do on our YouTube channel, and also our research center. If you're not familiar with our research site, if you can't be a client of Jazz Wealth, you can join us on the research site here, where we go over all kinds of different ways from they're either videos or posts to try to help you with what's going on in the stock market right now and help you determine the types of things that you may want to look for, right? And give you different ideas to kind of teach you how things work. We are financial advisors that actually manage our own portfolios here. So one of the things I get to do is teach you. And I hope you're ready, because today we're going to go a little deep, right? Hey, grab a pencil or something like that, because we're going to go a little deeper. Because we manage our own funds, I'm able to actually kind of teach people how it works. And so let's pretend today that you're out there, you're comfortable doing your own thing. You don't need Jazz Wealth. I'm just going to help you out with a little something to see how you might put things together and give you an extra something to consider. All right, on the August 13th Closing Beat show, if you want to see this, we covered a scan that we did in our watch list section there, Thursday, August 13th. And I'll just go over here and take a look. What we did is we shared a scan for different stocks that were large cap stocks that paid a dividend. So hang here with me for a second. What we did is we shared the top 7 of them, but I want to take it a step further with you guys today. Let's say you were looking for large cap stocks with a market cap of over $5 billion, right? So like ExxonMobil, $182 billion. You can see what's going on there. You also wanted a dividend yield that was greater than 4%. So anything higher than 4% is good. Around 4% is okay, but you can see something like ConocoPhillips, that's pretty low compared to what we have on the list. Then we added one extra bit of criteria, and we said, okay, expected earnings this year, earnings per share, we want to be lower than next year. In other words, we want to see that there is expected growth in the company from earnings. So we did plot that here. Great one for ExxonMobil. They expect a loss this year, but next year they expect to go back to profitability in terms of earnings per share. So there's a growth of about 1,800% there, which is how we rank this list. It doesn't mean that ExxonMobil is the best choice out of all of them. It's just they're expected to grow the most compared to the symbols that we have to find. So in short, we've got large cap stocks that pay a dividend of 4% greater or greater, and we want to see earnings growth expected year over year so that we're investing in something where they're positive as well. So we sorted the list here by projected earnings growth. As you can see, we've got a total of, I believe, 90-something stocks on the list. Now, when you're scanning for stocks to play, usually you'll do something like this, maybe not as in-depth, but you'll do something like that to say, okay, there's my list. How do I pick now what stocks to invest in out of the list? And so one of the things you could do is actually sort that list like I did and said, well, give me the best of the best in terms of earnings growth. You could also sort the list and say, give me the highest dividend yielders, or you could take it a step further and say, give me the highest projected consistent dividend payers, meaning they're currently paying something and they're expected not to cut that. Everything's fine. They should be able to do that. So we kind of did that here because we're giving you earnings growth. If the company's growing, naturally, as long as it's still headed towards the positive, they'll probably keep their dividend. Okay. So that's what we have here. We've got 92. How do you choose? Let's say you wanted to pick 30, 10, 20. You wanted to build a portfolio out of them. Well, you could just pick the top 30, and that's what I'm going to show you here first. You could say, I will take the top 30, and seems good to me. I'll buy all 30 of them. I'll build my fund, and that'll be kind of what we have going on there. You could say the top 20 or whatever you decide to do. Here's what we did. We plotted the stocks relative to their volatility. Nobody takes this into consideration, man. Take a look at this here. So here's all of those stocks. I apologize if it's a little fuzzy. It should be good. But what we did is we said, okay, show me the yield of the stock, which is going to be the y-axis there. So the higher you go, the higher the dividend yield. The lower you go, the lower. And then we said, now, let's plot that against the volatility of the returns that are historically played out for these stocks. So what happens is the more you go off to your right there, why can't I? There you go. The more you go off to your right, the higher, just say the more volatile the returns are going to be. Not that that's good or bad, it's just they're going to be more volatile. Meaning one month you may see 5% to the upside, the next month 5% to the downside, versus another stock where you see 5% to the upside, 1% to the downside, right? So the returns are less volatile. Anyways, As you're looking at the chart here, what you can see, and you can see my cursor, perfect. So you've got something like ExxonMobil. ExxonMobil would be the least volatile out of all of them, but it pays a lower dividend yield overall, right? So we can go back over here and we say dividend yield looking pretty impressive there in the long run, or that's just currently, right? So in the long run, you look at that and say, okay, got about 8% dividend yield. However, it's the least volatile, right? So that's interesting right there. As you work your way to the right, you can say, wow, look at Occidental Petroleum. Assuming they keep the dividend or they continue to pay it, that's pretty impressive, but it's more volatile than something like ExxonMobil. So the point that I'm trying to make here is you don't just want to randomly pick 30 or 10 of the top best results off your scan. You want to see how volatile they're going to be, because what if those top 30 were over here? Or you happen to pick Las Vegas Sands, Dow, Delta, Win, maybe WDC, maybe that's what you picked, and now what you're doing is you're accepting higher volatility for a lower yield overall, right? So we want to take this a little bit further. What I did is I said, all right, we're going to take these 30, right? Take the top 30 here and just assume we didn't know any better. Let's compare the performance and the volatility of that versus maybe something else. So let's take a look. Here is us just taking the performance of the top 30 with no consideration for, that's interesting, no consideration for anything else other than we want the best out of the thing there. So the black line is going to be the portfolio, top 30 stocks on the list I just gave you, and the orange line is going to be the Russell 1000, which is just the large cap. You could use the S&P as well if you like, but since we're using the Russell 1000, I use that as our index there. So what you can see is on the upswings, it is more volatile than the index, and it's more volatile on the downswings. Now, pretty much any portfolio you build is going to have some issues around that virus decline. So unless you were actively managing it, it's probably going to have fallen more than the overall stock market or index that you're following. Anyways, moving forward here, you can see that the volatility of the returns is very similar to the index there overall. Now, let's pretend you're retiring. And you said, Dustin, I want the large cap stocks with the best growth rate and the highest dividend possible, but I'm retiring and I've got this sequence of returns risk, meaning I don't want to be pulling money out while I see more dips to the downside. I want to try to squish that. I want to try to make it so that it's a less volatile account, but I still want the performance and I still want, of course, the highest dividend possible. So what we did is we took it a step further and we said, let's take the top 30 that have the lowest volatility out of all of them and see what we can get there. Now, if you plot the returns there, the black line, of course, is still the portfolio. The orange line is still the market in general or the index. Take a look at the difference. It's not a lot. Like on a chart, it's not easy to kind of see this, but if you take a look at the difference there, you now have a portfolio that is not moving as volatile as the overall index that you're following. That could be more important because this is not a growth portfolio. Someone is going to make the mistake of leaving a comment on this video that says, yeah, Dustin, but what about the returns? Are the returns different? Total return. That's what you're looking at for these because these are higher dividend paying stocks, or you hope they stay that way. And so that's what you're interested in, which means if we were to plot just the raw performance, it would look like they underperform. But remember, got that high dividend in there. So anyways, going back over to this one here, we now have built out of that list that I showed you right over here of all these stocks, we've now been able to filter it down and say, okay, let's go with the top 30 least volatile ones there. That way we have a less volatile portfolio than the index, and that's one way to look at it there. What I then did to wrap things up here, we compared the two portfolios together, and just, you don't need to see it, the text up there. Let's make this big. There you go. Okay, so what we did is we plotted the first portfolio, which is in blue. That is the top 30 in terms of growth. Who cares about volatility? Then we plotted that second portfolio, which is lower volatility with the almost nearly the exact same returns there. And as you can see, if you're looking at the red line there in the background, we have a lower volatile, less volatile portfolio in the long run there while still experiencing the same gains. This is important because imagine someone like us. We are managing portfolios for our clients. Do we want to show our clients wild daily back and forth swings? Or would we rather show our clients the same total return, but with less back and forth swings? Could you imagine the difference there, right? One has people calling left and right going, what are you doing? This is crazy. The other one has people going, all right, we're plugging along, right? And so it doesn't mean you have to accept lower volatility. If you want the higher volatility, that's fine. But it's just one way to look at it. When you are scanning for stocks, it's one way to think about how to make it more efficient, right? how to not just randomly buy stocks. It's such a problem these days. But anyways, hope you enjoyed that. Real short one there for you to try to go a little deeper than we normally do. We do that sort of thing on our research site. Hope you'll check that out. jazzwealth.com/research. If all of this is just extremely boring to you, or you're not getting the help like this from your financial advisor, we'll hope you'll consider us over here at Jazz Wealth. I'll wish you a great rest of your day, and thanks for watching. Oh, thumbs up, subscribe, all that great stuff. That helps. I know I don't say that enough, but it really helps. So if you would just hit the thing. Thanks. Enjoy.